So I had a interesting conversation today. Some customers are kind of payment sensitive. They could get approved for a home loan, but they didn't really want to come out of pocket with so much cash, and then also pay these higher rates that the market just continues to go up and up, and higher payments. So I thought I'd try providing an actual solution with a total cost analysis, and share it with a realtor here that has got a client that just can't get off the fence of really pulling the trigger to go buy a home due to the payment. So what's the scenario you have, Cricket?
So that was the question. It sounds like rates went up a little bit again recently, and we're at interest rate 8.3%, 8.3 something, 8.375. It's it's been one of those things.
If you want to buy a house today, on October 3rd, the market changes daily, but if you want to buy a house today and not have to pay a bunch of discount points in closing cost, you'll have to take a rate in the 8s. So, yeah.
Right. So then you were talking about a 2-1 buy down option, depending upon whether they needed PMI, that type of thing, and their down payment, right?
Right.
Because we're talking about a $500,000 house. We were looking at a 10% down type deal plus closing costs.
Yeah.
Again, I think the main thing that sticks them is just 8 point something rate, just sticks in their craw, I think.
Yeah, and then the payment's higher too, because you're looking at a payment with I estimated taxes and insurance, but you're looking at a payment of like $3,872 a month with 10% down payment at an 8.375% rate. Means they have to bring in around close to $57,000 to close on that transaction. But that payment is significantly higher with that 8.375 rate. And on a 2-1 buy down, just a simple 2-1 buy down where a seller can, instead of a seller trying to discount a house due to being on the market for 3 months or whatever, discount the price of the home by 5%, which would be $25,000 discount in price. They could go ahead and take a $500,000 offer and agree to pay a buy down of the buy down cost on a $500,000 loan or $450,000 loan would be around $11,000 in buy down fees. So they actually don't have to lose the $25,000 that they were asking for the house originally to get it sold. So a 2-1 buy down with monthly PMI will actually save you $653 a month in payment for your first 12 months on that loan. So what the seller's doing is they're putting money into escrow for you to help subsidize your mortgage payment for the first 2 years. So the first year, your payment is 2% lower than the actual note rate that you have on the loan. If you do refinance anytime within that first year, you would be getting a large portion of that money back as a principal reduction on your refinance, because that is your money to keep that the seller put into escrow for you. After a year, you would have a little bit less money, but you'd still have money in escrow after a year to pay down on that principal balance if you go to refinance. I went ahead and put down 4 different scenarios here. You can see the 2-1 buy down with the financed PMI, which saves you the most. So basically, with good credit, you can do what's called a single premium PMI payment, so that you don't have to pay PMI on a monthly basis, and you save the most money on your monthly payment because you don't have any PMI for the life of that loan. The 2-1 buy down with PMI, which would have the monthly PMI included in your payment, saves you $612.92. I wanted to put in a third, basically a third alternate option is a minimum down payment 2-1 buy down scenario with no PMI, with less money down. So you can basically put 6% down on a little bit over 6% down on your loan and finance in your PMI, and you'll have more or a lot less money to do at closing. So you can retain a lot of your cash in the bank for when the time comes to refinance. You can do another larger principal reduction, plus have plenty of money to move. But anyway, I thought it was real interesting, and I thought I wanted to share this with other people to show the difference on how you can advise your customers instead of just take an order on your customers. So in this case with Cricket, he can go to his sellers and his buyers and give them alternative options to purchase a home and make it a win-win situation for everybody.
Well, clearly, I thought it was important enough to pull over on the side of what must be the interstate for as loud as the highway's been here while we're talking. Yeah, it seems like an important point to, as you mentioned, not just order take, but to service the client's needs. So it sounds to me like, to boil this down, you've got an option that might show a lower rate for a couple of years while we're dealing with this tumultuous rate situation. That we feel is going to correct itself within the next 2 to 5 years, something in that vein of thought, right? So in the meantime, if the biggest problem you're having is you're paying rent right now, for example, because you're just not happy with that 8 point whatever rate, do the math on this versus what you'd be paying in rent for the next 2 years and how much that might increase. And again, something like this would be reasonable to do, even if, for example, you had to give a little bit more than you thought you should be giving for the property, but got the seller to buy the rate down for you instead of giving you a discount.
Yeah, and if you wanted to show this same scenario on a $250,000 purchase price for somebody that's renting, the percentages will work. I'd be more than happy to provide a detailed explanation on any scenario. I did show the $500,000 purchase price, which if you were renting a $500,000 house, your rent would be probably in the neighborhood of $4,000 a month anyway. But yeah, it could even be as much as $5,000. But it's always better to own and instead of rent. And in addition to that, property values are not going down. If you lock in your interest rate at 8.375, that's temporary. Could be a year, 2 years, 3 years. But if you lock in your price of a home at $500,000, it is permanent. That's what you paid for it. And then a year from now, when it's worth $530,000, you've already got $30,000 in equity in that home. So it's very important that you get with those professionals, both on the real estate side and mortgage side, to be able to give you those other scenarios instead of just searching on the internet, finding a house and going out and trying to buy a home and not really understand all of the implications of buying a home. So I appreciate you calling me, Cricket, and doing this presentation. I really hope that we can get more people in this real estate world to ask the right questions and give the proper advice.
Well, it's funny because, people act like it's supposed to be such a simple thing. I hear advertisements on occasion that will tell you, whether it's buying houses, cars, whatever, it's supposed to be simple. Well, yeah, one would hope that we professionals can help you make it simple, and we're going to, but it is complex, and you do need to understand what you're getting into, and you need to listen to the professionals like Ron when he lays out the 4 different scenarios that might be available. I had a conversation the other day with a client who was just trying to access a particular type of program because they felt it was going to be the best program for them. And every lender that they spoke to about it immediately cut them off and said, that's not the program for you. Here's a program that'll work better, and didn't really explain to them why. And when they came across you, you're the one that actually explained things in detail that made sense to them. So now they'll be moving forward with working with the lender because they found the right professional that actually speaks to them in a way that they speak. Right.
Well, bottom line,
so thank you for that.
Well, bottom line, you and I both are helping people with probably their largest financial asset in their portfolio that they will ever have. And some people are able to leverage that into larger portfolios of real estate, but having, the real estate under management as an asset, having both real estate agents and professionals and mortgage people helping manage that asset instead of just finding a place to live, it makes a lot more sense. And I think if we had more people doing that over the last 30 years, we would probably have a lot better name in the industry, because there's a lot of people that just take orders and move on down the road. So I appreciate you taking the time to go through this with me, and hopefully we can get back to doing some more bug in the, what was it? The bug in the
Bug in
bank.
the bank. Yeah. Mm-hmm.
But
One thing's for sure, you touched on an important point there. If you are an investor or are a home a purchaser of homes that plans to invest in real estate that way, that's one thing. But most of those people started off their investment by buying that home to live in themselves, and then they recognize the amount of wealth that they were able to build just by making that mortgage payment. And then someone like you or I came along and gave them that pro tip, right? Here's how you start to build wealth, the way that you're already doing it by building your own personal wealth. And that's really where we come in. So whether or not somebody just wants to buy a home and find a place to live and set it and forget it, Ronco style, right? Or whether they want to get into investing and figure out just how to squeeze every nickel of profit and value that they can out of their investments, folks like us that have that technical ability, we're the ones to call for sure.
yeah, well, I appreciate it. You
Yeah, buddy. Good to talk
have
to
a
you.
safe trip home.
Yeah, I will. Talk to you soon.